Well, the next Fed decision due out tomorrow. The central bank widely expected to hold rates steady as White House policy uncertainty and growth concerns rattle markets. But we could get more clarity on where rates are heading for the rest of the year. For more, Fast Money friend and Bessemer Trust chief investment strategist, also the winner of the 2023 acronym game, Jeff Mills.
Welcome back, Jeff Mills.
You know what? I decided not to come on in 2024 because I wanted to give everyone else a shot.
The acronym game.
Now I'm back.
Yeah.
I didn't take that shot too well. But
thanks
anyway,
to my co-host.
Welcome back.
So what are we expecting? Steve Leisman made a bold prediction, I think it was today, that the Fed would sort of unveil what their expectations were factoring in tariffs.
Interesting. I don't know how much we're actually going to get of that tomorrow. I think sometimes the consensus is right, so probably nothing on rates. What the market wants to see is some assurance that they're willing to be flexible with policy. That's it. I think as long as they say that, or if there's some adjustment in the dot plot, particularly looking out to December, then maybe the market gets what it wants. I think what we want to pay the most attention to is inflation expectations. That's going to be the key. If they remain anchored, then they can be flexible. Don't look at University of Michigan. I think that survey is not all that helpful, very partisan. But look at tips rates. I think they've gone up a bit, but stable. And I think that the Fed probably communicates some willingness to be flexible given the potential for risk relative to tariffs and growth.
Yeah, so explain that a little bit because you said the market wants this. So in the last meeting, it was, what do they call it, a hawkish pause? Is that right, what they were doing? So if we go back to September where they cut 50 basis points, they were worried about the jobs market, right? Mm-hmm. So is there some place in between there? Weakness in the economy gives them more likelihood to cut rates, and that's good for stocks?
I think you get a dovish pause here. It's a very fine line, right, Dan? I think if you end up getting 4 or 5 cuts this year, we have a major problem because they're reacting to something relative to growth. I would rather 1 or 2 cuts and the economy looks good and off we go. But I think the market is looking for some sort of put given the uncertainty. I mean, massive spike in any uncertainty index. You can look at all-time highs above COVID. I don't know that that makes a ton of sense to me, but I think the put from Trump is sort of off the table. So any reassurance from the Fed, I think, ends up being useful.
It's funny because I think the Fed put is probably lower than the Trump put. But I'm curious your view on another one of these great acronyms, MEGA, which is Make International Great Again. What are you doing on international? Because this is a case for, I'm sure, a lot of your clients. They haven't been investing internationally in a long time, and some of these fundamentals really have changed. Yeah, very true. I heard you guys talk about this a little bit last night. But in terms of where we're allocating capital, I don't think this is the year where you just want S&P 500 beta, for example. Mm-hmm. We tend to hold a very heavy U.S. overweight. We have adjusted that as we move through the first part of this year, particularly into Europe. So whether it's financials, kind of specifically in Germany, industrials, even a cybersecurity name here or there. So I don't want to be, following the crowd too much. But to your point, I think folks are still generally underallocated in Europe. And the policy uncertainty now between developed international and the U.S. is just so wide. Until that gap starts to close, that trade has more to run, I think.
Jeff, 4.28 and 10-year yields, where do they go from here in your opinion? I think higher. I'm not suggesting I'm right. What do you think?
I think you're probably range-bound, to be honest, and I know that's sort of a boring, safe answer, but I don't know that there's a major catalyst one way or the other. I'm somewhat concerned about growth, and that's why we're kind of reallocating capital a bit away from the U.S. I should state we still are very much overweight the U.S., but starting to look elsewhere. I think growth is more of a concern than runaway inflation, so I think that serves as some gravity on yields, and I do think the Fed ends up having the ability to cut maybe even more than the market is currently pricing in over the next number of meetings. So my guess would be flat to lower. And I think that would be okay for markets.